Yo, what's up, everybody? It's Monday, June 24th. I've been away a couple of days. I was up in New York and then I came down here to Florida. I actually relocated to Florida, folks. I like California. It's an amazing state. It's an awesome state. But I wanted some land, I wanted some property, and I just decided to come back to Florida. Or to come to Florida, not back to it. Actually, I was here last summer, right? I was doing my videos from down here. Then I ended up moving to LA and just came back. I bought a house down here. And so I'll be here from now on, folks. Yeah. Let's talk about what's going on in the market. All right, today we're still experiencing a correction in some of these, well, not some, but in the artificial intelligence, these stocks that have been hot, they've been on fire. You know what I'm talking about. Nvidia, Apple, Microsoft, not so much in terms of a pullback, but definitely Nvidia. I mean, I did a video last week, I think, when I talked about how Nvidia, its market cap in a very short period of time had surpassed the entire stock markets of Germany, France, and the UK, and it was pushing right up against the entire GDP of the state of California. But now it's back below 3 trillion. I would definitely buy it on a pullback. I don't know if I would be buying it right in here, but if it got down to, let's say, in the 90s, if it got into the 90s, even the high 90s, something under 100, I'd start nibbling at it for sure. So let's talk a little bit about the fiscal flows, folks. This tax drain, the recent one, and remember, we never really recovered the April tax drain. It was still before we went into this one, there was still a decent amount outstanding. And this tax drain put us back negative, like around 150 billion. I have to go and check out the numbers, but I mean, what struck me was, remember I've been talking about net government transfers, AKA the deficit. Net government transfers are now down 276 billion compared to last year. Now we were down. I've been tracking this all along, and I've been telling you guys when it was first down, like 70, 80 billion. Then it jumped to like 188 and 190 billion. Now it's down 276 billion. 276 billion is roughly about 1% of GDP. So you could shave right now. That's a permanent reduction in GDP of at least 1% from levels we saw at the end of 2023. And I say at least 1% because that doesn't take into account any multiplier effect from that. So like economists talk about a multiplier effect. When you get a cut in spending, all right, then that you can quantify, because 276 billion is basically 1% of GDP. But as a result of that lower spending, that kind of trickles through the economy that other people now, there's, since net transfers are lower, people have less, businesses have less, so then you get a multiplier effect. Sometimes economists put a 3 times multiplier on that. I don't know if that's necessarily the case here. But if it is a 3 times multiplier, then we're basically at zero growth. Okay? Now, it's going to be interesting to see what happens, because remember, I said when the Atlanta Fed's GDP now, when they came out with their very first estimate of second quarter GDP, and it was like 4.2%, and I said, that's never going to happen. I said it's probably going to be more like what we saw in the first quarter of 1.6%. I said it could even be a little bit lower than that. And sure enough, they had 5 downward revisions and they got down to 1.5%, exactly what I was talking about. But then they recently revised it back up to 3%. I haven't looked at it recently, but I'm going to have to take a look. But now with this drop in net government transfers at 276 billion year over year, what does that mean, folks? Let me just put it in very simple terms. That's 276 billion less transferred into the economy compared to last year. And another way you could say that is 276 billion taken out of the economy. Same thing. Okay? That's a decent amount. I mean, when I was talking about 70, 80 billion in the very early part of this year, I said, you know what? That's not probably going to be a problem because you're talking about a 1.5, 1.6 trillion deficit. But now we're getting into some numbers. Okay? 276 billion is nothing to sneeze at. Like I said, that's just on the surface a 1% haircut, and that's a big haircut. Yeah, I did get a haircut. That's a 1% haircut to GDP, not including the multipliers. So it could be as much as 3%, which means we got zero growth. If we have zero growth, the market's not going to do that much. It's not going to do very much at all. If we have slow growth, like I think right now, let's look at the optimistic scenario. The optimistic scenario, if you shave off that 1%, and let's say it just stays at 1% chopped off, basically we're talking about like a 2% top end GDP growth rate. Now, that's not terrible, okay? We've had many, many years historically in this country of like a 2.5% growth rate. So we're basically, it's reversion to the mean. We're going back to the fascinating thing is that it's still requiring like a 1.4 trillion, government transfers to keep the economy growing at 2%. I mean, we used to do that when it was like 250 billion, the deficit. It just goes to show you that, things, how can I state this? I mean, they're not very efficient right now. There's better things that this money could go into, that this spending could go into. Like if we created real capital, like right now, we're set. The spending is like money to Ukraine. It's money to Israel. It's plenty of money here. It's like money to Social Security. I shouldn't say all that stuff, but I mean, because Social Security is still the big one. Interest income transfers are the big one, okay? And that's going to people who already have money. So they're basically saving it. And savings is a siphon, is a drain on consumption and investment. If you save, the money sits there. It's not going to consumption. It's not going to investment. It's not flowing to corporate profits. Okay, so really, when I said it's inefficient in the sense that we're spending it, what the Fed did, which manifested now with their interest rate hikes and maintaining a high level. And it's so stupid on so many levels. Okay, it's stupid because it's not really taking care of inflation. It's leading to very large interest income transfers, so like fiscal transfers. But they're going to people and entities that already have money. So they don't need that money necessarily. I mean, they're sitting on it, they're saving it. And so you have a 1.4 trillion net government transfers, and that's only good enough for a 2.5% at best growth rate. I mean, that's, like I said, we used to do that back in the old days with a 250 billion deficit. Now it's taken that's just, if you think of a motor working really, really hard, okay, to create force, and it's taking more and more RPMs, more and more energy. It's heating up, like to maintain a very minimal level of force. And in order to maintain that level of force, that level of power, it's got to rev faster and faster and faster. So the slightest little reduction in that, in the revving of that engine, the slightest little reduction in these transfers, right away, boom, we drop down. Look, we're dropping down to like 2%, 2.5%. If we're lucky, I'm saying that's the top line. But let's get back to stocks, because I don't necessarily think that's bad. As long as we have growth, I've said this in the past, growth is going to show up in the stock market in the form of higher stock prices. The only variable, I would say, is the amount of time it takes for the market to climb. When you have a super powered injection of fiscal like we did in COVID, it goes straight up. And this past year, when we went with these interest income transfers, it went straight up since, the end of 2022. And all these monetarists, remember, they were all short. They were all bearish. I was the only one telling you guys, like, this is going to be very, very powerful. And I'm the only one telling you guys right now that there's been a drop of 276 billion in these net government transfers. And okay, the overall transfers are still going to be like 1.4 trillion, but that's down 276 billion from last year, which was like what, 1.7 trillion, and it's not even maintaining the same growth rate, because last year the growth rate was like 3.5%. Now we're going to be lucky to get 2.5%. Lucky. I don't even think it's going to hit that. So that's what we're dealing with right now. And actually, if you're a stock market investor, you should be cheering this. You should be happy about this. Why? Because it's going to give you opportunities to buy into the stock market. Now, let me tell you something. A lot of people, a lot of investors have chased this market rally in a FOMO, fear of missing out behavior. And I always tell you guys, that's wrong. That's not a good thing to do. That's not the way to make money. I mean, you have to have patience. You have to have discipline. I millions of times I spoke about this, literally. So you should kind of be happy if we're going to fall into a lower growth trend, because you're going to get more back and forth action in the stock market. And you should see that as a good thing, not as a scary thing or not as a bad thing. All these stocks, this paradigm of artificial intelligence and stuff like that, good or bad, it's not going to go away. Okay, it's here to stay. There's no question about it. So like these companies that are leaders in that field, NVIDIA, obviously, Microsoft, Apple, perhaps, Meta, they're all going to be very, very important in the development of this paradigm. So like when they go down, yeah, you want to accumulate these stocks. I've spoken about this many, many times, that the way to build wealth is to accumulate good assets over time and to hold them. I know a lot of people, you're not interested in that. You want bing, bang, boom, in and out, pa, 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 action, 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 like going to the craps table, the roulette, playing in Vegas. I can't help you with that. If that's your thing, you're in the wrong place. This is economic education. This is knowledge. This is understanding. This is, mental game and behavior. This is stuff I talk about. I've been in this business a long time, folks. So that's where we are right now. Not a lot to talk about in terms of commodities at the moment. I would say that commodities, if we have a slowdown in economic growth, you're going to see a pullback. But the macro trend, the longer term trend, I would say is still bullish if there's growth. Okay, so there's another place you want to be patient for a pullback. You're talking about oil, you're talking about gold, you're talking about copper, things like that. Industrial metals, industrial commodities. Okay, cotton, things like that. The dollar's in a bull trend, although I think, you're going to get your back and forth action in the dollar. You're going to get your pullbacks. A few of you asked me, isn't the dollar going up bearish for the stock market? I don't understand this. Like, by definition, a rising currency equates to a higher standard of living, especially for a country like the United States, which is we run perennial current account deficits. We're an import nation. So like that, if our purchasing power goes up, look, the real definition of standard of living is the stuff you have. It's not the money per se. I mean, it's like anyone could tell if they're in a rich country or a poor country. And you know how, it's not, you don't need to go into a bank and examine everybody's bank account to understand that. In a rich country, you have modern everything: roads, hospitals, universities, infrastructure, manufacturing plants, science and research, medicine, people, living in beautiful abodes, homes, nice clothes. You could tell if it's a rich country, and by the same token, you could tell if you're in a poor country. Go to Haiti, go to one of these poor, impoverished countries in Africa, Sudan or something, and tell me if you cannot figure out if that's a rich country or a poor country. Dirt roads, poverty everywhere. They live in shacks if they even have shacks. No medicine, barely any food, stuff like that. So it's the real assets which tell us whether or not our standard of living is high or if it's very low. So if the dollar goes up, I really don't see how you can make an argument that it's bearish. I would say that if you want to make an argument, you could say that it's going to affect some sectors of the economy and the stock market differently than other sectors, okay? But in the aggregate, in the big picture, it's not going to be bad. It's not going to be bad. I mean, Japan had a very strong currency for, since the late 80s, since the 80s. I mean, I started trading the yen like in the early 80s, and it just kept going up every single day. And all we talked about back then, some of you may be not old enough to know this, but all everyone talked about back then was Japan, the powerhouse, Japan Inc. We had our corporate executives going over to Japan, figuring out how they manufacture things. Their stock market surpassed the market capitalization of the U.S. for a while. It went all the way into the early 90s, and the yen went. I mean, originally the yen, when I first started tracking the yen, like in the late 70s, it was 400 to the dollar. And then it went all the way up to 95, 90 something, maybe 91, maybe even 89 to the dollar. Okay? Now it's back at 157, 159. So it's given some back. But all that period when the yen was going up, that didn't impoverish Japan. The Japanese stock market went down, but it went down, I believe, for other reasons. Like you had insane monetary policy, which relied on massive reserve additions into the banking system, which basically bankrupted the Japanese banks, made them insolvent. When you pile in reserves, like these central banks thinking, we got to give liquidity, but all that does is necessitate higher capital levels for the banks. And they just keep piling these. I mean, we had it close to happening here a couple of times when the Fed went nuts with reserve additions, and they had to they created that reverse repo facility just because of that they had to provide a facility for the banks to shunt off, to lay off some of those reserves so they wouldn't become insolvent or have to raise more capital. And on that note, I'm going to end with something that I saw posted online today, which again it's crazy land, folks. It's crazy land. And what it was, they said the Fed is something to the effect like the Fed is very concerned about a possible bank crisis. Now, when they're and I don't know if they actually said this. This is how it was headlined. All right. I'll tell you right now that the big banks, J.P. Morgan, Citi, Wells Fargo, Bank of America, they're fine. Okay, they hold the bulk of system reserves. Okay, so they're getting paid by the Fed. Fed's paying 5.5% on reserve balances. They're just, the Fed's giving them money. Like I said before, like the people who are getting money, or the entities that are getting money, they don't even need the money. They're getting more money on top of more money, not the regular people. But the smaller banks, the mid-size and the smaller banks have been hurt badly because the rate hikes that the Fed did, that undermined their capital. Okay, they had to mark down like government securities and other securities that they hold because of the rate hikes. And so when the Fed says, if they actually said it, but this was the headline, they're concerned about a banking crisis, almost stated in a way like, gee, why is this happening? Because you freaking did it from your policies. So anyway, I'm going to end on that. Anyway, that's it for today, folks. Please like and subscribe if you choose to. I appreciate it very much. It really helps out the channel a lot. And don't forget to go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. See you tomorrow. Bye.